Hi everybody, Professor Henry here. This is probably the first of two video lectures where we'll talk about issues related to Chapter 10, the process of making capital investment decisions. This follows up Chapter 9, where we learned some of the techniques for making decisions about investment projects. That is, we learned how to calculate, say, a net present value or an internal rate of return and make a decision on the basis of those criteria. But we assumed throughout that we already knew what the cash flows were that the project was expected to generate. We would start a problem in that chapter with knowing that, a particular project would have an initial cost of $1,000 and generate cash flows of 300, 400, and 500 over the next 3 years. And that's great. Knowing how to make a decision on the basis of that is important, but it's also important to be able to know where these values came from. How did we estimate these expected future cash flows? What I've shown here is an example of what you would call a conventional set of project cash flows, meaning that it starts with an initial investment, a negative cash flow up front at time zero, representing the cost of the investment. And everything beyond that in future periods is a positive cash flow. We make a single investment and we generate benefits in future periods. All the projects that you encounter in this chapter, at least in this class, will be of that nature. It's not necessarily always the case, but for simplicity, we'll keep it that way. The overriding principle in estimating or choosing cash flows, calculating cash flows to be incorporated in an analysis like this is to pick cash flows that are what we call incremental. Cash flows that we want to consider are cash flows that are incremental to the project. And the slide here gives a pretty good definition. Any cash flow or any expense or revenue or anything that will only occur if we proceed with the project and will not occur if we don't proceed with the project is incremental. That's what incremental means here. Is it something that will only happen if we proceed with the project and will not happen if we don't? Hopefully that'll make sense as we go forward and define some of these things. Anytime you're analyzing a project, and usually this takes the form of being given a story about a project. A company wants to build a factory to produce some product, and we're told what the costs are, what the selling price will be, and so on. And we want to be able to pull all that together into a rational decision. So when you're looking at these stories and you're told that the selling price of the product is $1,000 per unit, well, you should ask yourself, is that incremental? That is to say, will we receive that $1,000 if and only if we accept the project? That is to say, if we decide to build a factory, then we can collect the revenue. If we don't decide to build the factory, then we won't collect the revenue. The answer to that is yes. If it happens only if we accept the project, then yes, it should be included in the analysis. It is an incremental cash flow. The answer is no, it's not included. We'll see some examples of cash flows that are not incremental as we go along. I'm departing a little bit from the chapter here and the way the chapter does things. I'll use some of their examples, but the chapter here relies pretty heavily on some material that we didn't cover back in chapter 2, where they define some measures of cash flow that are pretty relevant. We cover that in Finance 355, Corporate Finance. We use the same book there, and those chapters are covered, but we didn't do them here. So I'm going to try to streamline things a little bit in Chapter 10 so that you don't have to rely so much on material, definitions, terminology that maybe we haven't actually seen. It is true that what we're looking at here, when we look at the cash flows from a potential project, we're looking at changes in the values on the company's financial statements. Anything that we're going to consider a cash flow is going to reflect itself as a change in either the balance sheet or the income statement, or I guess potentially both. Things like the fact that we're selling some new product as a result of building a new factory. Well, if our net sales increase, that's pretty obviously going to affect the income statement. If we incur additional costs as a result of operating this new factory and buying raw materials for the new product that we sell, represented by cost of goods sold, again, that affects the income statement, and that's pretty obviously something that's going to represent cash flows. These represent cash flows. Net sales would be cash flows in, cost of goods sold would be cash flows out, but nevertheless, they represent relevant incremental cash flows that we want to take into consideration. Less obvious are changes on the balance sheet, but they're very real. If a project requires us, if we build a new factory and we have to buy some additional raw materials inventory to keep the factory operating, as a result, we wind up increasing the inventory balance. That's a use of capital. If we're spending money to buy inventory in order to raise the amount of inventory we keep in the warehouse, that's a cash outflow and something we need to consider, because if it's incremental to this project, then we definitely want to include it. Anything really that affects the current asset or the current liability accounts on the balance sheet would be considered examples of working capital expenditures. Any changes to those accounts represent changes in the company's working capital, and they probably will represent relevant incremental cash flows. Another type of cash flow you're likely to encounter, and almost certainly would encounter, is capital spending, capital investment, and that is usually reflected here in the fixed assets portion of the balance sheet, where if we buy a new piece of equipment or if we build a new factory, we're going to be reflecting that as increases in this balance on the balance sheet. And again, that's a use of capital, but it definitely represents a relevant incremental cash flow. This slide kind of repeats what I just said, breaking those three categories of cash flows down. Operating cash flows largely are cash flows related to the income statement, the profits that result from selling a new product, or decreases in costs that result from buying some more efficient equipment. Those things have effects on what we call the operating cash flow, which we could define as earnings before interest and taxes minus the tax plus depreciation. Don't worry if that doesn't make too much sense just yet. We'll come back and elaborate on that a little bit more. As I mentioned in the previous slide, there are also cash flows related to capital expenditures, the purchasing of new equipment, new land, buildings, anything that, any capital goods that the company needs to complete the project is a capital expenditure, and usually it represents a cash outflow. There can be cash flows coming back at the end of the project if we buy a piece of equipment for $100,000, use it for 5 years, and then sell it for scrap for $5,000 at the end of the project. Well, that $5,000 coming back at the end represents an offset, a positive cash flow that offsets part of the initial negative cash flow resulting from the salvage value. And again, changes in the balance sheet, changes in the current assets or current liability accounts represent working capital expenditures. If we're buying new inventory, if we're creating new receivables, those are uses of capital. We have to put money aside to account for those, and those represent real, incremental, relevant cash flows as well. A big part of the challenge in Chapter 10 is just being able to read a story about a project and identify what's relevant, what's not. We'll see some examples as we go through of problems like that. Maybe in a later video we'll spend a little more time on that. There are certain cash flow types that you might encounter that are worth knowing about because they appear frequently enough in problems of these sorts. One example is cash flows that we might refer to as sunk costs. I said that in order to be relevant to our decision process, a cash flow has to be incremental to the project. That is to say, the cash flow occurs if we decide to go ahead with building the factory, and it doesn't occur if we don't go ahead with building the factory. That would be an example of an incremental cash flow. Not every cash flow that's related to a project, though, is necessarily incremental. And the very common example here is something like this. We're thinking about building a factory. Last year, we spent $50,000 to hire an engineering firm to survey the site and see if it's possible to build a factory on the land that we have. Well, it's certainly related to the project, but the thing is, it's not incremental. If we choose to proceed with building the factory, we've paid the engineers $50,000. If we choose not to proceed with the factory, we've still paid the engineers $50,000. It's an example of a sunk cost. It's something that's happened in the past, results from previous decisions, and something that we can't get back. It's the same whether we go ahead with the project or not. If it's not incremental, if it's not incremental to this project, it's something we just ignore. Sunk costs are always to be ignored. You'll also see potential cash flows that you might describe as opportunity costs. And usually I'll state this as a rule to evaluate resources used in terms of their opportunity cost. What I mean by that is this. Anytime you use a resource, say it's a piece of land that you're thinking about building a factory on, well, we can use the land to build the factory, but by doing that, we give up the opportunity to sell that land for cash to somebody else. And by using the land for the factory, we're incurring a cost. Even if we don't have to pay for the land right now, we are incurring a real cost of giving up the ability to sell the land. That's an opportunity cost. And opportunity costs are very real, and they should be considered. If we're thinking about building the factory, one of the things that is incremental and something we're giving up is the possibility of selling that land that we already own for whatever amount of cash. Another category of cash flows that you're likely to encounter are cash flows that are known as side effects from a project. These have different names, but they can be either good or bad. An investment can have either positive side effects or negative side effects. For example, if we build this new factory that we keep talking about, well, maybe we can also use the space to develop some additional products that we haven't even thought about yet. add some flexibility or lower costs of production for other product lines, there may be real positive benefits to other parts of the business from this proposal. That's something you should consider. If that has value, it should be considered. There can also be negative side effects. These are things like, typically what's referred to as erosion of sales or cannibalization of sales. If we develop a new product, if we're a hamburger stand and we decide to start selling hot dogs too, that's great. We'll get some new customers who want hot dogs, but we might also lose some hamburger customers who choose a hot dog instead. One product eats into the sales of the other product. If that's likely to happen, it's very hard to estimate, to put numbers on this, but if it's likely to happen, it's something that should be considered. Taxes, of course, are real, and we always want to look at cash flows from a project on an after-tax basis because that's what we get to take home at the end of the day. That's what the company gets to keep and use for other investments or return to the shareholders, is the after-tax profit from operating an investment. One that's a little surprising is the financing costs. We all know that businesses raise capital by selling bonds and selling stock, and we saw in Chapter 14 how those sources of capital have costs attached to them. So if we're going to raise $1 million and use it to build a factory, well, there will be a cost attached to that, to the use of that capital. It's tempting to want to, say, put the coupon payments on the bonds to mark them down as incremental cash flows to this project. If we're issuing bonds to raise money to build the factory, then that kind of makes sense. But it's not right to do that because, although you could proceed that way, remember, when we go to make the decision, we're going to figure out the weighted average cost of capital and use that to discount those expected future cash flows and find the net present value of the project. And when we use that cost of capital, we're accounting for the capital cost. We're accounting for the interest on those bonds and the dividends that the stockholders expect and everything else. So we don't, in the process of estimating cash flows, we don't include financing costs. If you go back through the early parts of the book, again, Chapter 2, which we did not cover and you're not responsible for, is where a lot of these terms that you see on the screen here are defined. These terms, operating cash flow from assets, net capital spending, and so on. There are a number of ways to figure out the amount of incremental cash flow that a project is going to generate, and you can certainly do that based on forecasting financial statements, forecasting an income statement, and pulling numbers from that forecast to fill this in. But in the yellow box here, I've provided a somewhat brief formula. It's not super brief, but it is a somewhat brief formula that you can use to calculate cash flow from assets, which is the total incremental cash flow resulting from the operation of the proposed investment. Here's an example problem from Chapter 10, pretty straightforward one. It's two problems, really. First problem is what we're doing in Chapter 10 to estimate the cash flows that come from operating this proposed investment. And the second part of the question, item 10 here, is to use those cash flows to calculate a net present value. Kind of the whole process. This is a pretty simple example, though, because it doesn't have a lot of the details that we have mentioned here in these slides so far. So let's take a look at the problem and see the bits of information that come from this. Keeper Incorporated is considering a new 3-year expansion project. 3 is important. We're being told that this project has a 3-year life expectancy. The project requires an initial fixed asset investment of $2.7 million. Again, this is a relevant piece of information. That's that capital spending or capital expenditure that we talked about. We're investing in fixed assets which have an initial cost of $2.7 million, and that's what we have to pay today. The fixed asset will be depreciated straight line to zero over its 3-year tax life. There's a good bit of information in the chapter about depreciation and how it operates, and I hope that in your financial accounting classes you've had a chance to learn a bit about depreciation and what it represents. Basically, the idea is that $2.7 million expenditure is being recognized in 3 installments over the life, over its useful operating life, let's say. Instead of thinking of this as an expense of $2.7 million today, we're going to think of it as an annual expense of $900,000 in each of the 3 years of the project's life. It would be kind of nice for businesses if they were able to expense capital expenditures all at once. In fact, in the current tax climate, that is sometimes at least the case, but that's not likely to persist into the future. Be that as it may, the standard practice is to spread out the recognition of those capital expenditures over their useful life. That's the process of depreciation. And here we're told that we're going to allocate $900,000 of that expense in each of the 3 years of the project's life. Okay, furthermore, we're told the project is estimated to generate $2.080 million in annual sales. There will be costs per year of $775,000, and taxes are paid at a rate of 35%. The question is ultimately asking us, what is the operating cash flow from this project? Again, a couple ways you could do this. I tend to like to lay things out as if we had a spreadsheet, but it's not always necessary, but let's do it that way. This project, if we proceed with it, will generate sales of $2.080 million. And it will incur costs of $775,000. And each year we'll allocate part of the expenditure, the depreciation, is $900,000 in each of the 3 years of the project's life. If you take sales minus costs minus depreciation, you wind up with a quantity that you would recognize from the income statement as earnings before interest and taxes. And just doing this math here, I have the result figured out. It should be $405,000. Given earnings before interest and taxes of $405,000, we would have to pay tax at a rate of 35%, which is to say we subtract 35% of this amount, so subtract 0.35 times $405,000, and you can do that math. After doing those calculations, and there are other ways to do this, I get a net income of $263,250. You could call this net income from the project. You could call it something some books refer to as net operating profit after tax, and they mean the same thing. Okay, cash flows. What we're ultimately interested in is how much cash could this project throw off to the owners of the company on an ongoing basis. And this number that we've arrived at here, $263,250, well, it's correctly calculated, but it doesn't accurately reflect that quantity. Why not? Mostly because of this depreciation charge. Remember, in year one, we're not actually writing a check to anybody for $900,000. It's not a real cash flow. It's a fictional cash flow. The IRS requires us to figure it out and allocate that capital expenditure over its useful life. And it's kind of a construct that is used to help us figure out the appropriate amount of tax to pay, but it's not a real cash flow. We didn't actually spend that money during the first year of the project. So although we had net income of $263,250, the true project cash flow is going to consist of that net income plus the depreciation charge, adding back the $900,000 worth of depreciation. Why are we adding it back? Because we never really spent it. It was treated as an expenditure here, but it wasn't money we actually spent. It was an example of a non-cash expenditure, and so we're undoing the effect of it here. The net result is we get what you would call operating cash flow of $1,163,250. Moving along to part 2 of this question, or question 10 from the chapter, calculating the net present value. Well, now we're able to do that because now we know this project had an initial investment of $2.7 million at time 0. We know that each year this project is going to generate incoming operating cash flows of $1,163,250 in each of the years 1, 2, and 3. So there's our timeline with cash flows. Finding the net present value could be just as simple as using a calculator or a spreadsheet to do that. We can flip over to the spreadsheet and perform the calculations like this. Okay, here's the spreadsheet. This is the financial calculator spreadsheet that we've been using throughout the semester. I've just created an area off to the side to calculate net present values of things by plugging in cash flows, and we've used that for several problems in class. Here I've copied the data from the example, the Keeper Incorporated that we've been just looking at. We had an initial cost of $2.7 million, an annual incoming operating cash flow of $1,163,250 in each of the first 3 years. There is no fourth or fifth or cash flow beyond that because the project only had a life expectancy of 3 years. Used the net present value formula here, and again, this should be familiar from the previous chapter where you used net present value to calculate NPV formula to calculate net present values of things. Bearing in mind that the net present value formula, the first argument is the discount rate or the cost of capital. We were told here that it's 12%, but again, that comes from an analysis, an estimate of this company's overall cost of capital. For now, it's just given to us. Second, the NPV formula takes the cash flows that are expected starting in year 1, not the initial outlay, just the first incoming cash flow in year 1. Those are in cells J4 through N4. Actually, just L4 here, but in row 4 in my example spreadsheet. I add back to that the negative cash flow occurring at time 0 because it's already in present value terms. Again, it's a little quirk with the way the NPV formula works in Excel or in Google Sheets, but something you have to get used to. And the answer comes out to be $93,930.22. Positive. The important thing to know about it is that it's positive. By investing $2.7 million today, we're creating an asset with a value of $2,793,930. The value of the benefits expected in the future outweighs the cost by this much. It's a good investment. You can also calculate the internal rate of return of those cash flows. It wasn't asked for, but you could certainly back up the decision by calculating the IRR of the cash flows just as it's done here. It turns out to have an internal rate of return of about 14%. And if we demand a rate of return of 12% from these investments, and this one promises 14%, again, this sounds like a pretty decent investment. Here is a somewhat more elaborate spreadsheet that analyzes the same project in a little more systematic way. Nothing wrong with what was done before, but this is a more generally useful way of laying out the analysis of a project like this. Started with assumptions here at the top, and these were things that were just given to us. So the amount of annual sales generated, the amount of annual costs incurred, the cost of acquiring the equipment needed, the tax rate. There was actually very little more information than that. We had a straight line depreciable life of 3 years. The assets are depreciated over 3 years, and that is also the duration of the project. We were also given for question 10 the cost of capital, but these are the bits of information that were extracted from that problem that we saw in the slideshow. Further down, I've done those same calculations to calculate first of all, the operating cash flows based on the income statement that's associated with this project. Income statement always looks the same way. Revenues minus costs minus depreciation gives us EBIT. Take away taxes, what's left is net income. And here we've got what we knew to be the project's revenue, $2.08 million each year for 3 years. Costs were to be $775,000 each year for 3 years. We figured on the previous page the annual depreciation amount. Here it's just calculated as the capital expenditure divided by the depreciable life, the straight line depreciation all the way down to zero. Those of you who are accounting majors will probably argue with that a little bit, but this is pretty typical for the analysis of investment projects in finance textbooks and finance courses. As we saw previously, that results in an EBIT of $405,000. The taxes at 35% of that amount is this much, $141,750, just based on the 35% tax rate, and resulting in a net income from the project of $263,250. The operating cash flow comes from taking EBIT, adding back depreciation, and subtracting taxes. There are other ways to do that. You can take net income and just simply add back depreciation. Either way, you wind up in the same place. We found this operating cash flow to be $1.16325 million, as we did on the previous slide. Further down the worksheet, I've got sections for working capital related cash flows and capital expenditure related cash flows. This project didn't tell us anything about working capital related cash flows. It didn't say that we need to increase our inventory by $50,000. It didn't say that we need to allocate receivables and some amount. It didn't tell us anything like that. So we have all zeros here. There was no working capital expense described. There's no recovery of working capital at the end of the project. These are just all zeros. We'll use that in a later project. But for now, you can ignore that. The capital expenditure, again, we're going to deal with projects where the capital expenditure occurs all at once, up front, as the initial outlay. At time zero, we're spending $2.7 million. There are no further capital expenditures occurring during the life of the project, and we were told that the salvage value of this project would be zero. So nothing to worry about down here. That's the only cash flow related to capital spending, the initial $2.7 million. Bringing those things all together, the operating cost minus the change in working capital minus any capital spending results in the total project cash flow from assets, if you will. And these are the same values that we saw in the previous worksheet, just laid out in a little bit more organized format. And again, calculating the net present value based on those leads us to the same result. Nothing is really different here from the previous slide, just using a slightly more organized approach to this. This is something we'll be seeing next week after the Thanksgiving break. You'll be seeing a project where you're asked to read a story, fill in the blanks here, figure out the net income from the project, the operating cash flows related to working capital, capital expenditures, and so forth, and ultimately make a decision. That's something we'll do next week. I expect another video with some additional details, some more things to think about in terms of estimating cash flows. There's quite a bit in Chapter 10, so do read the chapter overview. Do go through the Learn Smart exercise on Connect to develop a little bit of understanding of what's going on here. And again, expect another video with some more details about this.